Global Market Outlook, a window of opportunity. Since we published our Outlook 2022, both equities and bonds have faced headwinds as markets adjusted their expectations to price in a more aggressive US interest rate hiking cycle. Gold rose, fulfilling its role as a diversifier. Several indicators suggest markets are approaching the end of this Fed repricing process. History shows 10% plus pullbacks in major equity indices within larger bull markets are not uncommon. Hence, we believe the window to buy the dip is now open. Beyond our preferred equity regions of the US and Euro area, we see an improving outlook for Chinese equities, given the central bank's increasingly supportive stance. Within bonds, US European high-yield bonds are also likely to rise alongside equity markets, while Asia USD bonds should benefit from increasingly supportive monetary policies in China. The AUD, NZD, and CAD should benefit from both. Investment strategy and key themes. A window of opportunity. Since we published our Outlook 2022, both equities and bonds have faced headwinds as markets adjusted their expectations to price in a more aggressive US interest rate hiking cycle. Gold rose, fulfilling its role as a diversifier. Several indicators suggest markets are approaching the end of this Fed repricing process. History shows 10% plus pullbacks in major equity indices within larger bull markets are not uncommon. Hence, we believe the window to buy the dip is now open. Beyond our preferred equity regions of the US and Euro area, we see an improving outlook for Chinese equities, given the central bank's increasingly supportive stance. Within bonds, US European high-yield bonds are also likely to rise alongside equity markets, while Asia USD bonds should benefit from increasingly supportive monetary policies in China. The AUD, NZD, and CAD should benefit from both. A volatile start to 2022. It has been a rough start for investors in 2022, with equities and bonds both suffering amid shifting US monetary policy expectations. Since we published our Outlook 2022, global equities and bonds have declined C.6% and C.3% respectively. Gold rose as much as 3.5% before pairing some gains, fulfilling its diversification role, and the USD is up C.1%. Within equities, developed markets have underperformed emerging markets as central bank policy expectations diverged. In the US, the market debate has centered around how far the Fed could tighten in 2022. While in China, the debate has focused on how much further the PBOC could ease. Are 10% equity sell-offs normal? The rally in global equities and high-yield bonds since March 2020 was punctuated by very few and shallow pullbacks. However, history shows us that equity markets are usually more volatile. The S&P 500 index witnessed 6 pullbacks of 10% or more during the 2009 to 2020 bull market. A longer history going back to 1930 also shows us that the S&P 500 index pulled back by an average of 16% peak to trough during the US midterm election years. With the benefits of hindsight, the best decision from each of these pullbacks on a 6 to 12 month perspective was to stay invested and, if possible, use the volatility to one's advantage by buying on dips or selling the spike in volatility to generate income. Staying in cash out of fear of further losses was usually the worst decision outside of recessions. Could the current sell-off be the start of a larger bear market? We believe not. Historically, bear markets almost always occur alongside an economic recession. Economic growth data, though, remains very strong, and forward-looking recession indicators are not signaling a recession. Have markets bottomed? Timing the precise bottom in global equities remains difficult. However, we would take comfort from three factors. First, a Fed hiking cycle appears to be well priced. For 2022, for example, 4 Fed rate hikes are already priced in, and the market narrative is questioning whether more hikes are likely. We think expectations have overshot and expect the Fed to hike only thrice as growth slows towards trend in H2 and inflation and supply chain pressures start to ease. Second, despite the ongoing inflation debate, long-term inflation expectations have actually fallen to their lowest level in almost a year. If the Fed's goal was to avoid inflation expectations becoming unhinged, this measure suggests it has been successful, buying it some breathing room should growth falter or equity and corporate bond market weakness become excessive. Third, technical charts argue the uptrend has further to go, albeit at an increasingly gradual pace. All these factors, when placed against the historical context that temporary volatility around the first hike of a Fed hiking cycle is common, mean we should start averaging in now rather than attempting to time a precise bottom. Is policy turning in China? The debate in China is the polar opposite to that in the US. Despite several easing measures, PBOC Governor Liu Guoqiang said the central bank would roll out more measures to stabilize the economy. For Greater China equity markets, we believe the shift in policy direction and increasingly supportive technicals point to at least a short-term rebound in indices like the Hang Seng. Longer term, we also favor the industrials and consumer discretionary sectors. In Asian high-yield bonds, default expectations seem excessive, with market pricing pointing to default rates at the high end of analyst expectations. We continue to see a change in policy direction as a key catalyst. This has started at a macro level in the form of interest rate cuts, but reports suggest more specific measures to support real estate sector liquidity could be in the offing as well. Has the USD peaked? The USD index's break to a new trend high on the back of rising Fed rate hike expectations strengthens the case for some further gains on a 1 to 3 month horizon. However, it does not impact our long-term view that the USD is likely to peak once rate hike expectations are fully priced. We would watch for a break below 94 on the USD index as one signal that the USD has peaked. We favor the AUD, NZD, and CAD on a 6 to 12 month horizon because of favorable interest rate differentials and their tendency to be correlated with continued global growth and gains in riskier assets. Themes. Below, we provide a brief overview of our currently open thematic ideas, coupled with some recent highlights. Key themes. Embracing a digital future. It has been a difficult month as many high-growth equities and technology stocks sold off on the back of higher bond yields. While valuations have come off, most of our sub-themes continue to trade at a premium to global equities, with the exception of CoinShares Blockchain Global Equity Index, which at 12.9 times 12-month forward PE is at a discount to global equities at 15.5x. Earnings revisions remain largely positive across the board, with strong earnings upgrades seen in cybersecurity, while fintech has now dipped slightly into the negative territory. As a result, we have seen a larger YTD pullback in fintech versus cybersecurity, blockchain, and IoT, given a lackluster near-term earnings outlook from key companies in the fintech space. While the outlook on our digital themes may be weighed down temporarily by economic normalization and the moderating pace of earnings revisions, we remain bullish over a longer-term horizon. International Data Corporation expects spending on cloud infrastructure to see a compound annual growth rate of 12.4% between 2020 and 2025, reaching USD 118.8 billion by 2025. Private sector competition and a need to secure the digital environment should further support growth in technology-related fields. On a long-term basis, the sector's correlation with rising bond yields is weaker as earnings growth tends to dominate, and while higher yields could be a short-term headwind, we believe the long-term drivers for digitalization and innovation remain. Any significant pullbacks represent opportunities for longer-term investors. Valuations on fintech, cybersecurity, and IoT have corrected lower to 25.4x, 34x, and 29.3x, respectively, in the last month. The winds of climate change. The performance of this theme has declined since publishing our 2022 outlook, and this is likely due to the rising yields since renewable energy projects tend to rely on future profits. While yield volatility and greenwashing look to derail the outlook for the theme, we believe the climate momentum persists with strong government commitments and an underlying shift in the normalization of climate investing. Earnings revisions seems to have stalled, and valuations have dipped slightly, but long-term demand drivers for the theme remain intact in our view. The EU's proposal for an effective ban on the sale of fossil fuel cars from 2035 and the implementation of a carbon border adjustment mechanism appear supportive of Europe's goal of transitioning towards net zero by 2050. Banking regulators in the US and Europe are also looking at implementing climate risks tests, with new requirements on how banks report environmental risks and carbon targets to improve transparency to investors. This could further push for more green investments in the financial sector to aid banks in aligning their activities to become greener. We thus believe that any market weakness can be an opportunity for investors to average in over the coming quarters. China's common prosperity. During the recent World Economic Forum, China has made it clear that the common prosperity policy remains a top priority as it is aimed at narrowing the widening wealth gap. Although technology, education, and entertainment firms have been hit hard due to crackdowns and short-term regulatory headwinds remain, we believe this could eventually lead to a realignment of company strategies as they transition to a new norm. While earnings revisions remain in the red, we are beginning to see valuations for high-tech manufacturing, green energy, and China Internet coming down slightly, becoming comparable to that of Chinese equities. An existing government program looks to support local startups and develop a technology industry comparable to their counterparts in the West. We view this renewed interest in the initiative as a signal of strategic importance that these little giants will play in promoting China's competitiveness and reaching the common prosperity goal. We are therefore confident that our theme will benefit from the Chinese government's policy shift and retain our conviction. Perspectives on key client questions. Audrey Hall, CFA, Senior Cross-Asset Strategist. Is it time to bottom fish in equities, especially in tech sector? Risky assets have had a wobbly start to the year. Since we published our Outlook 2022, global equities have declined 0.6%, led by a sell-off in the technology and consumer discretionary sectors. The Nasdaq tumbled 13.4%, breaking below its 200-day moving average, while US and German government bond yields rose to their highest levels since the pandemic, reflecting higher inflation-adjusted yields and fears of over-tightening by the Fed. Higher yields usually do not deter equity markets. Historically, equities have been able to digest the impact of higher yields, albeit with higher volatility, if the yields were rising due to better growth expectations. This is especially true for tech equities, which have been resilient amid rising yields. While hawkish central bank rhetoric could temporarily increase volatility and cause the occasional correction, it should not undermine the case for equities to outperform bonds over the next 12 months, in our view. Any temporary volatility around the first Fed hiking cycle is normally an opportunity for investors to add risk exposure. The challenge comes when the driver of higher bond yields and a hawkish monetary policy is surging inflation. Such a scenario raises the probability of a combined sell-off in bonds and equities, as we saw in late 2018. While near-term US inflation remains at multi-decade highs, we expect it to peak soon and moderate by H2 as a vaccine-driven normalization in activities eases supply bottlenecks and encourages workers to return to jobs, cooling wage pressures. This should allow the Fed to tone down its hawkish bias, enabling equities to deliver positive returns this year. Non-profitable tech sector among the hardest hit from a hawkish Fed and higher yields. The Nasdaq has declined almost 16% over the past month, but this has masked an even bigger correction seen among many smaller tech firms, with some declining as much as 60% from their highs. Less profitable tech companies have suffered the most because rising interest rates sharply reduce the present value of their future cash flows, given that a greater proportion of their cash flows is derived far out into the future. Since 2009, the Nasdaq has witnessed 6 episodes where the index has declined by close to 15% over a 3-month period. Such episodes tend to be rare, and with the benefit of hindsight, the best decision during each of these pullbacks would have been to stay invested and even buy on dips. Also, investor sentiment is extremely negative, suggesting a bounce may be due. The AAII US Investor Sentiment Bullish Index, an indicator that measures individual equity investor sentiment, fell to around 20%, among the most pessimistic readings over the past 20 years. More than 80% of Nasdaq stocks now trade below their 50-week moving average. Some investors are drawing comparisons with how the Nasdaq bubble burst in 2000 to 2002. We believe the current Nasdaq index is fundamentally different from those days. The Nasdaq nearly doubled in 5 months during late 1999 after 4 consecutive years of over 20% returns, creating the tech.com bubble. There is no such run-up this time, with the Nasdaq only 39% higher than its pre-pandemic February 2020 levels. Unlike in 2000, the Nasdaq is now dominated mostly by profitable global leaders in their industries. This was not the case in 2000. The market consensus expects Nasdaq EPS to grow C.13% in the next 12 months, which is vastly different from the sharp decline in profit growth seen from 2000. Valuations, while still elevated, have eased to 26x forward PE from 33x in August 2020, nowhere close to the over 50x forward PE at its peak in March 2000. How earnings evolve will be key for tech stocks. Earnings growth remains an important driver of performance. The past decade of enduring growth in profit margins have enabled technology stocks to perform even in a rising rate environment. This year, while the sector has underperformed, MSCI Tech earnings growth estimates have remained largely unchanged at 10.2% over the next 12 months versus a month ago, compared with 8% growth estimated for broader US equities. The pace of earnings revisions has slowed recently, but they remain firmly positive, i.e., we have seen more earnings upgrades than downgrades. All in, we may be closer to a short-term bounce in tech equities, considering how oversold technicals are and the widespread pessimism. While the sector may remain under pressure due to tighter monetary policy and valuations longer term, the sector is at the heart of digital transformation, which we expect to continue to propel economic and earnings growth and productivity, especially in a post-pandemic era.